It's Monday, June 27, and this is the video log. It takes 30,000 to a million. I'm going to go through the account and show you the positions, compare my performance to the S&P 500, and then I want to talk about some banking stocks and dividends. So this is the account. I'm sitting at 181,425. Gained mainly because of the after hours action. I was virtually flat on the day. I haven't had a day this flat in quite some time. So I'm not sure what the markets are going to do tomorrow. Let's see what the futures are pointing at. Sometimes it can be a good indicator of what's going to happen. The futures are pretty flat. Alibaba's pretty flat as well. So the markets are telling us absolutely nothing at this point. No clues. Just what's going to happen tomorrow. Could be a down day, up day, flat day, don't know. So going to go through the options first and scroll down really quickly. You can feel free to pause the video player any moment to try to figure out the exact position that I have. All the information that you'll ever need about these positions contained within this little box here. Numbers on the right represent the daily change in value in percentage terms and in dollar terms. So some things that stand out are I managed to sell a call option for Goldman Sachs. And I want to talk about Goldman Sachs in a little bit. PayPal keeps dropping, huh? All right, these are my two equity positions. It's a relatively short list. 1, 2, 3, 4, 5, 6, 7 of them now. And considering the fact that I may be exiting 2 of these positions fairly soon, I'm going to have only 5 positions left, which is going to be the smallest portfolio that I've ever had. But I want to do that. I want to make it a more concentrated account. So Smith & Wesson, if it reaches $15 per share, will be out of the account. It was much higher than that, but unfortunately I had sold call options against my position, so I didn't want to touch it. But I would have sold at 16.5, and now it's down in the 14s again. So hopefully it goes up above 15 by July 15th. So we got a few weeks for that to happen. We'll see if it happens. 1,200 shares of Smith & Wesson. That's like $18,000 worth. The other position that is going to disappear is Paramount. If it manages to reach $30 or above $30, either by the end of the week or the following week. I haven't touched the position yet. I have 1,200 shares of that as well, and have a dividend pending apparently. I also have not sold call options against it to try to get out of it yet, because I'm waiting for it to get closer to $30 before I do that. It had a nice 1% update today, so that was helpful. Hopefully it continues on that way until I can finally sell the position. I'm going to go into, that's not what I want to go into. The investing tab real quick, just to show you the margin here, the leverage. I'm sitting at 36% leverage margin used, which is 72% leverage. The reason I double it because once this number gets to 50%, that means that half of the account is leveraged. Therefore, I'm 100% leveraged. That's how it works. I don't know why they do this, but I guess it makes sense either way. These are the acquisition positions sorted by total return and then sorted by equity. My Apple position is absolutely enormous now. It's almost $118,000. But I will be reducing that. So I already sold one call at 149. So if it reaches 149, I will be saying goodbye to 100 of those shares. I meant to have about 630 would be a good number for me to have at this point. Although I wouldn't mind owning a lot of Apple going into this fall. Reason being is that actually they have a ton of products that they announced they're gonna come out with this fall. I heard on a video article, I guess, that they're going to have a product line of about 20 products this fall that they're going to be selling. That includes like new watches, new phones. I really hope they get rid of that notch on the phone. It's definitely a big pull for me. I think it's going to be the hottest selling phone season ever, even though that we're going into we're in a recession basically. I think it's going to be a very, very hot quarter or year for them for phone sales. They also came out with new chips, and that's gonna upgrade the entire lineup of products. So that's great. So Apple, I'm really bullish on Apple at these prices for sure. I'm just trying to collect premium, and I'm collecting premium pretty far out. Right, it's like $5 higher than the current price. But this definitely has. I think Apple has the potential of hitting an all-time new high next January when the numbers come out for their holiday sales. Or actually, I don't know when they report. I think maybe February. I don't know, but whenever they report for the holiday season quarter. All right. Next, we're gonna go into the performance. It's everybody's favorite part. Daily performance flat. Weekly up 11.39. 1 month in the green. Amazingly, 1.74. This is the bad one here. The 3 months down 4%. 1 year up to 17. The old time. Whenever I show the old time, I have to make sure I let everybody know that I started investing here in August 2018. So the reason it was flat, the account was flat before that, is because it just didn't have much money in it. Now let's compare that. So let's go over these numbers real quick again and compare it to the S&P 500. So flat, up 12, up 1, down 4, up 2, down 4, up 2. The S&P measured by SPY, the ETF that tracks the S&P 500, was up, it was actually down today, 0.4%, up 4.6 on the week. 1 month is down 5.39, definitely outperforming that. 3 months, I was down 4%, S&P 500 is down 14, so crushing it on the 3 month. Whoa, that looks like a really bad graph. Looks like it's heading lower, huh? It's probably going to be a red week, guys. Brace yourself this week. The 1 year performance down 8.94, and I think I was positive on that. Yep, by 2%. So doing a lot better. I think mostly because the Chinese stocks decided to turn around. So I think that contributed to some of my outperformance. And I was able to exit all my shares, but I do have leaps left for Alibaba, for JD. I have 4 leaps. And then I have, 4 leaps. No. I don't know if you can count this as a leap. But long-term options for Alibaba. And then I still have those 2 for PayPal. I'm hopelessly trying to see if this company actually turns around. Maybe we'll do a video on PayPal and see what's going on there. But it was a negative day for PayPal, really bad. Down 2%. Look at this 1 month chart. So the week only up 2. The 3 month chart is down 33%. So not very nice. The 1 year chart down 74% for PayPal off its highs. So that's a pretty major bear market. Like, people talk about the bear market and how we're down we were down 20 some percent, but the growth sector and a lot of the tech stocks and a lot of the ones that have inflated valuations for one reason or another have definitely come back down to earth. So this is very, very painful for a huge sector of the market. Like, the down 20% doesn't do it justice. Like, I think PayPal being down 74%. Some of these names have been hit really hard. I mean, PayPal is not the only one on the year chart that looks like this. I know this is just this stock is not that good of an example, but if you look at DocuSign, down 76%. What's another? Let's see how Palantir is doing. Palantir Technologies. 1 year chart down 64. What is the I don't know. You name a stock. I mean, there's a lot of these high flying stocks that've come down like 80, 90%. I forget what was it. Oh, let's see how Peloton is doing. Peloton Interactive. 1 year chart down 91.15%. So if you had all your money in Peloton, you've literally just lost everything. All right, you've got decimated. So now Zoom, that was a favorite. Let's see how Zoom's been performing in the 1 year chart. Down 70%. Zoom actually, it looks like it's bottomed out. It was down 77%, but it looks like it bottomed out and now it's on the way up. So that's actually an encouraging sign. I mean, if Zoom is leading the way up, it's a very market sensitive stock. We might actually be close to or be hitting the bottom soon. Don't quote me on that. I'm expecting a down week this week. All right. I wanted to talk about bank stocks. So the big thing about the bank stocks is that they came out with very positive, basically all of them, very positive stress test results from the Federal Reserve, and that gave them the green light to start returning more of that capital that they had on hand to shareholders. And considering that about 30% of the finance sector returns, historical returns, come from dividends, that is a big deal. The reason also that I think it's a big deal is because if banks have the confidence to dispense this cash, that means they're not that worried about systemic financial banking related risks. They know their books better than everybody, and if they think they can handle it, I know that in 2008 obviously they thought they can handle that too, but post 2008 everybody's got a clue. I don't buy the opinion of many people that banks are going to be as reckless as they can, and the only thing that's holding them back is the Federal Reserve's opinion of their health. I think that banks are responsible, and the reputation still does matter for banks, and I think that they're doing the best they can for their company. They're pushing it as hard as they can with while knowing that they're not going to be bankrupting the company. So I think that they're smarter than we give them credit to, and if they're increasing dividends, that's a really positive sign to me. I mean, they kind of have to, especially if the rates go up. They have to compete with those higher yielding treasuries, and so they want to be seen as providing a better return. Otherwise, why would you hold a bank stock if you could just hold government bonds and get the same yield? It doesn't make much sense. So they have to increase the yield. I think Goldman Sachs increased by like 2.5%. Let me see what Goldman Sachs dividend yield is right now. So dividend 2.64, and so that's going to be increased by a little bit. Oh, it's increased to $2.5 per share. So I don't know. I can't work out the percentages right now, but $2.5 per quarter on that would make $10. So that's 3%. Okay, I guess I just did the math. So from From 2.64 to about 3% dividend yield. And banks are gonna make more money in this environment, in this high rate environment, because they make money off of the spread, right? The spread that they borrow money from their creditors, which is you and I. I don't know if you knew this, but if you put money in a bank, you're basically the bank's creditor. Like, they use your money in order to make money. So they take that money, you take money from a lot of places, but and then they reinvest it at higher yields to people with like business loans or vacation loans or like auto purchases, mortgages, etc. And so they collect the spread and they can leverage that and make it into a meaningful amount. So they make quite a bit of money, and when that spread increases, they make even more money, and now they can return that money to their shareholders, which is not the creditors. Okay, shareholders different. Yeah, shareholders the ones are the owners, like us, meaning like from through our brokerage. But us as consumers, we're actually creditors, right? Anyway, that discussion's gotten a little out of hand. But yeah, I'm happy to see it. I just can't. I hear all these warnings, right, from like Michael Burry and everything else. And he's been right in the past, and economy shrinking, contracting, and all this stuff going on, and inflation killing everything. But just looking at the numbers and the earnings that these companies are getting through, the confidence from the CEOs, the increasing in dividends, like the trends in new products, I just have a hard time like getting bearish. Even though I know that we're in a bear cycle, the trend is your friend, right? I know market's probably gonna go down, but I have a really, really hard time staying bearish like just a few years out, even just next year. I'm pretty bullish on the economy. Like, even though it's on paper, some things are contracting, inflation is killing a lot of the consumers' ability to consume. Just what they do, right? But I do think that oil prices will come down eventually. Some of the oil prices have been high for quite some time, and I'm sure that it's encouraged a lot of investment. I mean, I think that shale is going to boom again because they require high price in order to enter the market, in order to start production. And I think that a lot of other companies are going to, reinvigorate their investment in oil around the world, in the Arctic or whatever the hell they decide to drill. So I think that that's already happening. I don't know. I don't have the numbers or figures or anything like that in front of me to tell you, but I do think that oil price will be, eventually come down a little bit, which will free up some money from the consumer. And I think with the rates being quote unquote normalized, I think the economy is just going to get into a higher gear and just start kicking really, really well. So I'm pretty optimistic, especially from what I'm seeing in the companies and judging the actions of the CEOs of these companies. So I know short-term bear, long-term bull, that's pretty standard, but I can't even be a bear in the short term. Like, I just have a hard time buying puts or doing any kind of like major bear moves at the moment. All right, I'm going to leave it right there. I've been blabbering out for a while. Hopefully y'all made money. Butcher that one. Hopefully y'all made more money than I did today, because that was pretty flat. And you didn't lose anything like the market. And I'll make another one tomorrow. Peace out.